The following is an independent analysis based on public data by Corporate Lab. It is not investment advice. Leading into the highly anticipated second quarter of 2026, the semiconductor industry was bracing for Texas Instruments' earnings report. This financial dashboard captures the headline numbers from that release. Revenue hit $5.46 billion, a 23% year-over-year increase, and earnings per share came in at $2.14. That EPS print punched well above the $1.95 consensus estimate modeled by Wall Street analysts. Management had beaten their own April benchmarks across the board. Yet in after-hours trading, the market sold off, pushing the stock down over 2%. To understand this divergence between top-line strength and market penalty, we have to pull apart the income statement. We need to isolate the cyclical revenue recovery from the structural margin pressures that are masking the company's long-term capital strategy. Texas Instruments occupies a unique position in the global economy. Because they hold a leading share in the analog semiconductor market, their domestic operations and global footprint serve as an early indicator for the broader health of the industrial supply chain. While capital tends to chase the latest AI hardware stocks, TI builds the foundational analog and embedded processing components that physical industries actually run on. Because of this positioning, management actively resists optimizing for quarter-to-quarter earnings surprises. Analyzing this company requires ignoring the standard quarterly noise and looking directly at the mechanics of their long-term free cash flow engine. This stacked bar chart maps out exactly where that $5.46 billion in revenue came from. Year over year, the analog segment grew by 26%, while embedded processing expanded by 16%. That growth was largely driven by two distinct catalysts. First, revenue from data center applications doubled from the previous year. Second, the automotive sector hit a clear inflection point. Analog chip demand surged alongside electric vehicle assembly momentum, specifically within the Chinese domestic market. This waterfall chart tracks how revenue translated into profitability. Gross margins expanded sequentially by 340 basis points to reach 61.4%, driven by higher factory loadings. This pulled the bottom line upward, generating a 48% increase in operating profit, reaching $2.3 billion. It's worth noting the reported $2.14 EPS included a 5-cent tax benefit, not factored into the original guidance. Even with that adjustment, the top-line data confirms that a broad, cyclical semiconductor recovery is actively underway across multiple critical sectors. If the recovery is so broad, we have to ask what is dragging down the post-earnings valuation. Back at our waterfall chart, the answer lies in heavy depreciation costs created by the ramp-up of new infrastructure, primarily the SM1 facility. This depreciation acts as a structural anchor, suppressing near-term profitability even as top-line revenues increase. Beyond internal costs, there is external weakness. The industrial sector continues to struggle with ongoing inventory corrections. While the industrial segment did see upper single-digit sequential growth, the baseline inventory normalization process is taking much longer than analysts originally projected. Management explicitly factored this into their forward guidance, noting that standard seasonal weakness adds significant macroeconomic uncertainty to the second half of 2026. Institutional investors are discounting the stock because the immediate costs of physical expansion are compressing the margins generated by the top-line recovery. To properly value the company, we must move away from the quarter-to-quarter EPS obsession. Instead, we must focus on management's stated primary objective, the long-term growth of free cash flow per share. Looking at the trailing 12-month period, the company's powerful operational cash flow engine generated an impressive $8.66 billion. To see how that cash is distributed, we look at the pipeline branches. After physical investments, the actual free cash flow sits at $6.5 billion, equaling 33.6% of total revenue. From that pool, $5.8 billion was dispersed directly back to investors through dividends and stock repurchases. Simultaneously, a massive $3.3 billion capital expenditure outflow was allocated to build geopolitically dependable capacity. This heavy capital spending is subsidized by the CHIPS Act, forming the core of a $60 billion master plan to onshore critical semiconductor manufacturing. Texas Instruments is intentionally sacrificing near-term operating margins to construct a durable, geopolitically secure supply chain advantage for the next decade. This institutional data header documents an enormous strategic shift announced alongside the earnings, a $7.5 billion acquisition of Silicon Labs. The rationale here is specific. The acquisition allows them to rapidly scale their edge AI processing capabilities and absorb new market share. Executing a capital deployment of this magnitude requires a tight executive transition, marked here by CFO Rafael Lizardi handing the role to Julie Knecht. They are simultaneously building out the physical manufacturing capacity and acquiring the future-facing product portfolio required to fill it. This brings us back to the post-earnings sell-off. Texas Instruments is currently navigating a strictly bifurcated market reality. The bullish case rests on the left, executing in a recovering analog market, capturing data center demand, and delivering 23% revenue growth. On the right sits the bearish counterweight, intentionally absorbing near-term margin suppression through heavy capital expenditures and facility depreciation. The Q2 2026 results show TI prioritizing its long-term manufacturing capacity over its immediate market valuation. They are funding a domestic supply chain today to ensure they have the internal capacity to meet demand over the next decade. This video is an independent research analysis produced by Corporate Lab and does not constitute financial or investment advice.